Okay. We received the loan on the 1st of May, 2015. In other words, we had access and the use of this loan for 2 months in the current year. Okay. We therefore have to account for the interest of those 2 months in the current year. And that will be accrued interest. So how do we calculate that? We say it's 20%, 20,000 Rand times 15% times 2/12. And that equals 500 Rand. Everybody happy with that?
Yes.
Okay. Accrued interest equals the 500 Rand. I'm just going to say see note below. Okay, let's go back to the question. Very important here, they say the total amount of the loan will be repaid in full on 30 April 2018. Okay, nothing there. Then 3.3. On 30 June 2015, a check was made out to JC James Computers Limited for 6,000 Rand. This payment was... Yes.
Can I also disturb you just a moment to explain also, can you also make notes to explain the 10 years on 3.1 that you said if the repayment is not stated, we put it as it is, and if it's stated, can you please explain that again?
Okay. So I'm just going to make a short note there. So long-term loan. Basically what it just says is that if a portion of a long-term loan becomes repayable within the 12 months after the current financial year, that portion will be removed from non-current liabilities and showed under current liabilities as the short-term portion of a long-term loan. So of the 75,000 Rand, 7,500 will be payable on 2 July 2015. So in other words, within 12 months after the current financial year. 7,500 will be showed under current liabilities, and the remaining long-term loan will be shown under non-current liabilities. Okay. Everybody happy?
Yes, sir.
Cool. On 30 June 2015, a check was made out to Jesse James Computers Limited for 6,000 Rand. The payment was for the rent of a server from 1 July 2015. Look at the date. To 30 June 2016. When does our financial year end?
30 June.
So this is a prepayment.
Yes.
And here they say the transaction must still be recorded in the accounting records of the entity. Should you do anything with that?
Yebo.
What must you do?
Isn't it already? Is it the thing?
Would you not just reduce the profit for the year by the 6,000 Rand?
Would have to increase it because it was deducted. Wasn't deducted. Isn't it prepaid expense in a way? Prepaid expense relating to it.
But guys, basically, equity and liability does not include any rent.
Guys, all the things that you are saying is accurate, except for one thing. They say here the transaction must still be recorded. So it hasn't been recorded yet. The problem would have been if it was recorded, because then it would have been a prepayment, and then my profit should have been increased because it's rent for next year. It isn't the current year's rent, so it shouldn't be included in the current year's expenses. So that means
the bank will be decreased. Wouldn't the bank be decreased?
The bank is, and there we hit the nail with the hammer, or the nail on the head, or whatever. Because if we look at bank is currently an overdraft of 6,750, and that payment is 6,000. But now you must remember what we record in our statement of financial position. What does it say? The statement of financial position as at. So if the money has already left our bank account, then there's nothing we can do about it because it's our balance as at. But they say the transaction has not yet been recorded in the accounting records of the entity. So we can assume that it hasn't been taken into account at all. So you guys are happy with that? Do you see how important it is to read very carefully? Because if we want to use it, we're going to use it because we're not going to pay attention to either the dates or what is being said. So after that, are you guys happy that we don't do anything with that line?
Yes.
Yes.
Yeah, satisfied.
Kamogelo, you happy?
Yeah, I'm happy.
Kerry?
Yes, no, I'm happy.
Okay, can I just ask them? So
Yes.
in a case whereby our bank balance is on the debit side, are we going to record it?
Well, they say the transaction must still be recorded in the accounting records of the entity. So obviously we can't really do anything about that part because it has already been probably taken out of the bank from the check. But if we didn't record it, it wouldn't have gone into our journals. In other words, we wouldn't have touched the general ledger, and the general ledger wouldn't have gone to the trial balance. So on our side, on the accounting record side, we would not have adjusted the bank balance yet, if that makes sense. Everybody happy with that? Okay, 3.4. During the year, each partner received 27,500 as a salary, and these amounts were debited to salaries and wages. Are there anything wrong with that sentence?
Yes.
Yes.
The salaries shouldn't have been, what is it, debited to the salaries. You would have to go to the current account. But you just have to correct
Goes to
the
the drawings
mistake.
account.
We just have to correct the adding. We have to
It
basically
goes
have
to
to
the
add.
drawing.
It's supposed to be drawings, not because once it's paid during the year before the financial year, it should be drawings.
100%. So,
And it will affect our profit for the year
exactly.
because it has been deducted. So we need to increase the profit for the year with 55,000, I think.
100%. So salaries and wages is an expense account and it affects our profit. Salaries to partners are not shown in the salaries and wages expense account, but it is taken to their current account. If they took their salaries, that will then result in the salaries going to the drawings account of the partners. So in this case, we will have to credit the salaries and wages account, therefore increasing profit because we are reducing an expense, and we will debit drawings account because every debit must have a credit and every credit must have a debit. Everybody happy? Okay. So we will keep mind of that. So we've read through all the adjustments now. So let's start. Let's start with our statement of changes in equity. We always start with the opening balances. So let's look at the given information. So the given information gives us the capital of both partners, and nothing in the information tells us that the partners increased or decreased their capital. In other words, their capital have remained the same opening and closing. Current accounts. Here they give us the opening balances. They give us the opening balances of the partners. So let's carry them in or put them, record them. The other one, remember, it's a debit, so it will be a negative for us. Because never forget that we are doing the books of the partnership from the perspective of the partnership, not the partners. In respect, from the perspective of the partnership, from the perspective of the business. So it actually means that we owe Mary 4,350, if that makes sense. Okay, then we have the asset replacement reserve. Again, it's just given Nothing else is stated in the given information, so we can assume that it was there in the beginning as well. Then the appropriation account will never have an opening balance. Okay, and now we start recording all the items that affects the capital of the partners, the current accounts of the partners, and any one of those various headings. And then the first one that we need to look at is the profit for the year. But that profit requires some adjustment. So let's say Calc 1. Profit for the year. Calc 1. What is the given profit? $168,625. Everybody happy? Then they say additional information. So the 3.1, it says additional information, but it doesn't tell us that this specific loan, we haven't yet calculated the interest, unless I'm reading it wrong. The mortgage on the loan was acquired and bears interest at 10% per annum. So we can assume that it has already been calculated and taken into account. Everybody happy with that?
Does that mean then, Charles, that you wouldn't include that interest for the mortgage under your current liability? Because remember, with the loan to the loan from the partner, we included the interest for the 2 months on the current liability. So in this case, do we not include it under there because the interest has already been accounted for?
Let me just open it. So you're talking about this section?
Yeah.
That will actually, Lauren, I'm actually happy you say that, because if I read the given information, there's no indication that that interest has been paid. But also it doesn't state there that when interest is payable. So it's kind of a 50-50 on whether we did we pay the annual interest when it was due. Should we still accrue for it? It's a 50-50. The information is silent. So so let's say this was the exam, and you're now in this situation where you don't know, because of the way the information is given, you don't know whether you should account for the interest. What is the accounting rule? Because that's the only thing that you must know. The accounting rule says that if interest is accrued and it hasn't been paid yet, then we must account for it under current liabilities until such time that it is paid, which is normally within the next 12 months. So that's the accounting rule. But the question is silent on whether it has been paid or not. So if you include it, then you must state on your paper, you must make an assumption that it hasn't been included. So in your case, you're going to sit with a multiple choice question. So if you calculate your answer, say for instance, this was an answer, calculate the accrued interest on loan, or calculate the balance of the current liabilities. That's typically how your multiple choice will be. They will say, they can ask you, calculate the total of current liabilities. And then they would want to see, did you know that accrued interest had to be in there to get to the answer? So if your answer, if you don't get to the answer and you didn't include this section, I would then say go calculate it and include it. And if you then get one of the answers, then unfortunately that's the way you'll have to play it. But at this stage, this specific question paper is silent on whether this information is included or not, or whether the interest has been accounted for or not. But just by merely saying that there's no accrued interest account, we could have paid the interest. So it's kind of a situation. Because in 3.2, it's specific, and the thing that makes my point here is in 3.2, it specifically says, when the interest will be charged and when it will be paid. And that tells me that it hasn't been taken into account yet. Because they say there it will only be charged and paid on 31 December. So that tells me it hasn't been taken into account yet.
I understand. Thank you.
Okay, 100%. So since we've accounted for it as a current liability, we would have credited accrued interest. So every credit must have a debit and every debit must have a credit. So since it's an expense, interest, if we have to pay interest, it's an interest expense, we will debit the interest expense account, which we must still do. So this will be interest on loan from partner. That's minus 500. Salaries and wages. It's just to exclude the partner's portion, and they say here, during the year, each partner received 27,500. Each partner, there are two, so it's 27,500 that must be added back. Comes 2. Everybody happy? Okay, so that will be the profit for the year. Any questions so far?
Where is the 55,000 from?
Just repeat that question for me.
Where is the 55,000 from?
It is the 27,500 times 2. Because it's during the year, each partner received 27,500. There are 2 partners, so it's 2 partners times 27,500. Okay.
Okay, thank you.
Okay, so we've added that. Now let's continue to the question. So now let's account for the partner's salaries. The partners are entitled. Now we go to the what are they entitled to? They are entitled to a salary of 35,000 Rand each. Let's go to each one of them. We're not paying any heed to what has actually been paid yet. We will get to that.
Sorry, Charles.
Yes, Sitabiso.
I just want to find out point note 3.4 about the salary. Now that they pay during the year, is it not? They no longer fall under drawings.
So just repeat your question for me. I can't hear you clearly.
I'm saying on note 3.4, during the year, each partner received 27,500. I'm asking if we do not take it to the drawing, since it was Because during the year, when does
Yes.
that apply?
We are still going to get to the drawings.
Oh,
But you are right. It is taken to drawings. You are 100% correct. But now we are first dealing with what are the partners entitled to. So they are entitled to salaries, and they are entitled to interest that is calculated at 10% per annum on the opening balances of the partner's capital and current accounts. So there's two interests. Interests on capital and interest on current. So there's two of them. Interest on capital is 10% on the opening balances. And also interest on the current accounts, also on the opening balances. Everybody happy? Guys, please make sure that your student numbers are in the chat section of this meeting. If you haven't copied it in there, please do so now. So there we have the interests, and now we need to deduct the drawings. So let's first take it to them, minus. First adjust the appropriation account. And now we get to the distribution of the appropriation account to the partners. So when will you know what to do there? If you look at their capital situation, they own an equal portion. So that's already an indication, if you look at the capital, that they share everything 50-50, because that their contribution to the business was equal. We can safely assume that this column must be equally, the balance of that column must be equally divided between the two partners into their current account. So let's first take off the drawings. So here they tell us what the drawings are. So 35,750 and 43,650, but we must pay attention to 3.4 because I said during the year each partner already received 27,500, and these amounts were debited to the salaries and wages account. So if they were debited to another account, it wasn't debited to the drawings account. So that 27,500 must still be included into this drawings account of each partner. Everybody happy with what I've just explained?
Can you
Yes.
just repeat about if it's debited to another account?
So remember, for every debit there must be a credit. So if they took money as salaries and we've debited the salaries and wages account, it means we debited salaries and wages and we obviously credited bank. And we couldn't have debited drawings. So we've debited the wrong account. We should have debited the drawings account and not the salaries and wages account. So now we are correcting that by saying it is their drawings as given in the information, the 35,750, plus what they've already taken, which was incorrectly debited to the salaries and wages. Everybody happy? $650, 27,500. Now we're going to say profit, and that will be 50% of the sum of that column for each partner. So you add that entire column up and times it with 50%. And the amount will be the same for both. And in this column, you will now have that balance. And if you total this column, it will now be 0.
Can I ask a question?
Yes, please.
Drawings, isn't it supposed to be deducted?
You are right. Apologies. Okay, everybody happy?
Sorry, Charles, I just want to ask, are you not duplicating the partner salaries? Because you've put it in the partner salaries as what they're allowed, but then you've increased, you've taken again within the drawings. Does that not duplicate? Oh, I see, hang on. Okay, yeah, there's the money coming in. Okay, I'm sorry, I see my mistake.
No problem. Yeah, it's good. There we give, there we take.
Yes, with you.
100%. Any more questions on this, guys?
Can you elaborate on that? I didn't get it.
Just say again.
Can you elaborate on we said if there you give, there you take. I just want to know how the drawings came to 63,250 there, because in the notes they say it was 27,500.
So this is salaries to partners and drawings. So here we already said that salaries and wages is an expense account and it affects our profit. So salaries to partners are not shown in the salaries and wages expense account, but it is taken to their current account. So if they took their salaries, that will then result in the salaries going to the drawings account of the partners. Okay. We can assume that the balances, that the trial balance as per the given information does not include these drawings yet, since the incorrect account was debited. And here we say, in this case, we will have to credit the salaries and wages account, therefore increasing profit, and we will debit the drawings account of the partner. And that's why here we added the 27,500 to each one of their accounts, because it's their drawings account. Okay, everybody happy with that?
Can you just go back to the written explanation quickly, please? Thank you.
So now we can add the totals together. The capital of the partners will be the closing balance of each one of their accounts, the 275s. The current accounts will be the balance of the two current accounts added together. And the asset replacement reserve will be the 22,500. The bank overdraft was 6,750, if I recall correctly. Trade payables, creditors control, 15,000. I don't think there's anything else that we've missed. Okay, everybody happy?
Super.
Any questions?
Yes, sir. So if it's not, I'm seeing that the appropriation profit you calculated is 50%. Is it because they didn't state how the profit is shared among the partners? We will just assume it's 50% for each.
Yeah, if they didn't tell, which they would probably always do, but if they don't tell, the capital contribution is the way that you will split the profit, because that is what each of them contributed. But in most questions, they will tell you the partners share profits and or share in the profit and losses equally, or 3/5 and 2/5. They will tell you, but if they don't, the capital structure is the next best indication of how profits and losses should be split.
Charles?
Yes.
Can you scroll up for me, please, so that I can have a look at the equity? I'm just busy writing that down. Thank you.
Guys, 100%. Just on that, I will be sharing the solutions on the WhatsApp group, eh?
Hi, Charles.
Hi, Setaviso.
I just want to find out, I'm still confused at how we got to add, why we added the 27,000, the 55,000. What was the reason for us to add 55,000 to the total income?
You are quite unclear, Setabiso, so I'm just going to repeat your question. Just tell me if I get it right. You want to know why are we adding the 27,500 to the drawings account, basically?
No, I want to know why the 55,000 is added to the total income to make it 23125.
Okay. So remember, if you go back to the question. Okay, so first, let me ask you this question. Salaries to partners. Is it an expense or not? Sitabiso? Just say again.
Yes, it is an expense. It is
Okay.
an expense.
Okay, no, it isn't. So that's the first thing that you guys must remember. Salaries to partners are not accounted for as expense. So that is why any payment to a partner goes to his current account if he didn't take it, and if he took it, it goes to the drawings account, never to salaries and wages. So salaries to partners are never accounted for as an expense. So because the question tells us here that it was added to salaries and wages, we must remember that accounting principle and know that payments to partners are never part of the salaries and wages expense account, so we must add it back to our profit. It shouldn't have been deducted in the first place.
Okay, no, I'm covered.
Okay, I'm happy. Any other questions on this?
For the current account under equity, where is the 89,925 coming from?
Just repeat that.
For the current under equity, where you typed out equity, where is the current account of 89,925 coming from?
Oh, It's the balance of these two accounts.
Oh, those two added together.
Yeah.
Thank you.
Any other questions, guys, before I conclude this question? %, guys. I'm just quickly, yes. Okay, guys, we can go to the next question. I just want to quickly unshare and save this question for you. Okay, guys, if there's anyone that wants to be added to the WhatsApp group, that's how you go about it. Just remember that, please. So if you want to be part of this WhatsApp group, it's on the screen at the moment. You can send me your module code, this module code, and your name to that number, and I will add you to the WhatsApp. So I'm just going to check that WhatsApp group now, and if there are anyone that wants to be part of that group, I will add you now. Otherwise, we are just continuing. Can I take off the number from the screen? Okay. Carry on. Let's go to the next question. Let's go to the required part first. It says, prepare the statement of profit or loss and other comprehensive income of Santa Maria Close Corporation for the year ended 30 September 2015. Your answer must comply with all the provisions of the Close Corporations Act, number 69 of 1984, and the requirements of International Financial Reporting Standards. Comparative figures are not required. Okay, so we know we have to do prepare a statement of profit and loss and other comprehensive income, and we know, so now we know what they want for when they want it. Let's go to the top part. Let's open the question. And you can already start your question. So for those of you that are doing this with me, so let's do it. So it's Santa Maria Close Corporation, statement of profit or loss and other comprehensive income for the period ended 30 September 2015. Guys, and if you see me do something that you don't agree with, please unmute your mic and tell me. I'm doing this question with you. So, and I'm explaining, so the chances of me not putting a minus sign in or something like that is really great. So if you see that, question it immediately. Okay. Just give me a minute or a few seconds rather. Okay. So here they give us the list of balances, and that will give you an indication of how your statement of profit and loss should start. Because remember, normally a statement of profit and loss, as you would know by now, as you've studied from the first few chapters, is that it will usually start with sales and cost of sales. So let's just confirm whether that will be the case. So if we just look at this rather quickly, we will see members' contribution, loan, SARS, allowance of credit losses. We go down, our eye would immediately catch sales and purchases. So we can already say sales and cost of sales will give us our gross profit. And then we will have other income. Let's leave about 5 lines open. Then we'll have admin, distribution, and other expenses. Let's leave about 10 lines open there. Then you will usually have finance charges after deducting of finance expenses. After deducting that, you will get your profit before tax. Then you will get your income tax. And then you'll get your profit for the period. Then you will have other comprehensive income. You say 3-4 lines open, and then you will have total comprehensive income. And that is how you should know the layout of your statements, because it immediately tells you where your information will have to go to. There we have sales, and that will give us our gross profit, and that will give us profit before tax. Income tax, that will give us our profit for the period. Other comprehensive income will give us our total comprehensive income. Okay, let's go back. So there we have the members' contributions. We have a loan. So next to loan, you can say loan from Sarah. So it's a liability. So possible interest expense, if you want to make a note there. SARS, income tax calculation. Allowance for credit losses, possible increase, so credit losses expense. Inventory, if not otherwise stated, we can already assume that that's our closing balances because it tells us the balances as at 30 September 2015. We have a long-term loan, accrued expenses, prepaid expenses, sales, purchases, delivery expense in respect of sales. So that's a sales expense, part of admin, distribution, and other expenses. We're going to forget about that one, so let's go put it in. Delivery expenses. And let's put in brackets that value. 9840. Everybody still happy? Any questions so far? Okay, carrying on. Is everybody happy with me putting delivery expenses there?
Yes.
Yes.
100%. Here's my question paper. I've lost my question paper. Okay. Then we have depreciation. So let's go put depreciation in. Just to note it, because we know it, so we don't forget about it. Rental income. Put it in brackets. 10,900. Then we have sales returns, and sales returns goes down. We take it from sales.
Sales, yeah.
So let's go put sales in. Guys, we haven't done this question yet, hey?
No, we haven't done this question.
Okay, please tell me if we are repeating questions. I have so many questions and a lot of modules. The chances of me repeating a question might also be good. And then I remember a question, but I don't know whether I remember it from this semester or a previous semester. Sales, and we said the sales returns were 38,000. That's what we've got there so far. Rental income sales returns we've dealt with. Purchases returns must be part of my cost of sales calculation. So let's go say there calc 1. And let's scroll down. Calculations. We have calc 1. Cost of sales. How do we calculate cost of sales? Opening balance.
Opening inventory plus
purchases and purchase related expenses,
and then less our closing inventory.
Also purchase returns. And then we have less closing inventory. Everybody happy? Let me just take that there so I can have a bit of space.
Yes, sorry, Charles.
Yes.
If I could just ask a question. I done a question this afternoon with regards to they give you the cost of sales, but they also give you the purchases. Do we only then just use the cost of sales that they give to us in the question?
It depends, Delisha. Sometimes they give you the cost of sales, but if they give you all the variables to calculate cost of sales, it wouldn't do harm in calculating the cost of sales because their cost of sales might be incorrect. Or they can give you cost of sales and the question can actually ask you to calculate the closing balance of inventory. I don't know what the question asked you there. So if it was, say, for instance, do the statement of financial position and it then gives you the cost of sales, obviously cost of sales has got nothing to do with your statement of financial position, but it might aid in obtaining either the opening balance or the closing balance for whatever purposes relating to that question. So it's more, I think, if they've given it to you, it's either to calculate that it is correct or to use it as a variable to get to any one of these other costs.
Okay, now the question was with relating to do the 4 statements. So you had to do all 4 statements and cost of sales happened to be, the figure happened to be in there, as well as inventory and purchases, but it didn't have the other variables. So that's the reason why I'm asking. But I saw at the end that they only used the cost of sales and variables. So I'm just asking, yeah.
You can send me the question if you want. I can just have a look for you.
Will do.
So let's look at what they give us. They give us purchases, 398. And they give us purchase returns of 8,300. Minus 8,300. And let's see what else they give us here. Okay, now let's just continue with the information. Salaries and wages. So let's go to admin. We have salaries. Guys, this is just my method of attempting a question. So you can follow any other way you want, but this has proven for me personally to make sure that my answer is as complete and that I've taken everything that I can take to get marks from a question paper out of it, because sometimes we tend to focus on difficult calculations and we actually forget that there is given information in the question paper which can give free marks, but we forgot to take it out of the question paper. So that's the reason why I do a question the way you are actually seeing me doing it. So purchase salaries and wages, 472,820. And then we have land and buildings at cost, debtors control, interest on loan from member. Where would we put that normally?
That's interest income.
Everybody happy with it? Is as interest income?
It's finance cost.
Just say again.
It should be a finance cost.
Under finance cost.
Yeah, it's interest on loan from member. So it's a from member. So it is a liability. So it must be an expense. The only thing I'm doing with that, since there will probably be a calculation, is under my finance charges, I will say interest on loan from member.
Charles,
or you can just say member loan if you want.
Charles, I'll just go into the question. And I see for this one, they didn't tell you to actually calculate the the interest on loan, but because it's short, they're almost expecting. I'm saying it's different from the one you did in the previous question. That one, you had to ignore it, and you said normally they don't give us certain information, we don't have to do it. But on this one, they gave us a portion of it that is out.
Yes.
If you understand what I mean, they just want to catch you out.
Exactly. So you have to read it very carefully, because in this we will get to the information now, but you must always read the information in what are they trying to tell you. So if they give you the information to calculate the interest, almost like Delisha's question earlier on the cost of sales, it wouldn't do harm in recalculating it, because why are they giving you all the information to recalculate? Because they would want to try and see, do you know that it can either be an accrued expense or a prepaid expense, for instance. Okay. So then we have the other four items: telephone expense, stationery, water and electricity. So let's go put that in. Telephone, 12,800. Water and electricity. Did I do that now correctly? 14,300. Stationery. Stationery is 6,600. And we have insurance and advertising. Advertising, 8,600. Okay. Now we can start with the information. Additional information. Interest on hand on the 1st of October 2014, in other words, opening, is 46,000. So it's the opening, so 46,000. So let's go put that into our calculation here at the bottom, 46,000. So we've dealt with it. Interest for the current year, you guys must pause me if I'm going too quickly, hey? Interest for the current year on the long-term loan from Third National Bank at 15% per annum must still be accounted for. The long-term loan was obtained on the 1st of October 2013 and is secured by first mortgage over land and buildings. The long-term loan is repayable in 4 equal installments as from the 1st of October 2015. So that tells us if we look at this date, no repayment has occurred yet. In other words, the amount that is there is still the full amount. So we can apply the percentage on that amount, which is 15% times 224. So if we go to the information, our answer, and we say interest on loan, it will be the full amount, 224 times 15%. Everybody happy? So that's point 2.2. 2.3, Mr. Obas, a debtor who owes Santa Maria 6,000, was declared insolvent and his debt must be written off as irrecoverable. So the moment that you read that, you know, credit losses. But we don't know whether that's the only credit loss, so just write it in brackets. We say 6,000. And they say the allowance for credit losses, very important. The allowance for credit losses must be adjusted to 7,000. So let's go see what it is currently. Allowance for credit losses is 4,000. So it must increase from 4,000 to 7,000. So that increase must also be added to credit losses. That's the accounting principle. Everybody happy with that? So from 4 to 7 is also 3,000. So it's 6,000 plus 3,000. So minus 9,000. Okay. 2.5. The loan from Sarah was obtained on the 1st of October 2014 and bears interest at a rate of 10% per annum. The loan is repayable in 5 equal annual installments as from 1 November 2015. So as with the previous loan, they only start repaying this loan on 1 November 2015. So the balance as per the trial balance is currently the full balance that we must apply the 10% on. So we can just check and see if it is correct. So let's say loan from Sarah, if you apply the 10% on the 100,000, it should be 10,000 Rand, and they've only accounted for 4,000. So that is minus 10,000. Everybody happy? 2.6. Insurance expenses include an amount of 600 relating to insurance premiums for October 2015. In other words, it's a prepayment. We've paid an expense we have not yet incurred. And in this statement of profit or loss and other comprehensive income, we can only include expenses that we've incurred. So we have to go to the line item of insurance and say minus 600, which will then give us 7,200. Sarah and Maria are entitled to a monthly salary of 10,000 Rand each. Their salaries were paid during the year and are included in salaries and wages. It is wrong because we must say salaries to members. The salaries to members is 10,000 Rand each. So it's 20,000 Rand per month. So it's 240,000. So it is 10,000 times 2 times 12. what must we do now with salaries and wages? We must say minus 240. So we exclude it there and we include it separately. 472, 820. Do you guys see how important it is to understand the layout of your financial statements? Because if you didn't know that, there was nothing to understand there. It is literally just the way the statements are required. Okay. Then income tax for the year must still be recorded. That must still be recorded, amounted to 52,752, which you may assume to be correct. So let's go and look at the opening balance. So we say, or the current balance. So we say SARS a debit, meaning that's what we've paid. We have already paid 10,400. So we still owe SARS the difference between the 10,400 and the amount given, but we only have to work with the amount given since we are doing the statement of profit and loss. If we did the statement of financial position, then we would have had to use that SARS amount of 10,400 less the 52, that is the current income tax expense, and the difference would have been a current liability, income tax payable. So income tax given as 52,752. And that is that. So let's start with the cost of... Yes.
Why are we subtracting salaries to members twice?
We're not subtracting it twice. We are including it here and excluding it there. So we are just taking it from salaries and wages, the general account, and we are taking it to its separate line. So that's why I'm putting 240,000 there and I'm subtracting 240,000 there. So I'm making that expense less and this expense more.
All right.
You happy?
Yes, thank you.
100%. Okay, so now let's calculate this part. There were no other purchase-related expenses that I saw, so correct me if I'm wrong. The closing balance of inventory. Where's inventory? Why am I missing? Okay, there we go. 120,000. Okay, so there we have cost of sales. Everybody happy with that cost of sales? Sales is the 1080. 1080. Cost of gross profit is then difference between the two. We had rental income of 10,900. Then we had all the expenses. Quickly complete them. Delivery expense 9840. Depreciation was given as 8640. Telephone then we have our finance charges. Profit before tax will then be the gross profit plus other income, less distribution, administration and other expenses, less finance charges. So 143,800. Everybody happy? There were no other comprehensive income. Everybody happy? Any questions?
Yes, Charles. I just wanted to know, that other comprehensive income, what would we put there? Would it be like the asset reserve or CCs?
Yes, if there are any adjustments to reserves, additional distributions to members, things like that.
Okay, thank you.
Okay, everybody happy? Any other questions before me?
Charles.
Yes.
On that interest, for if we were to do the financial statement of financial position, so that means it will be under, the other portion will be under a short term because it's payable from the 1st of October 2015.
Correct.
Will we deduct the short term portion from the other one?
Yeah, we will take out
From
the
the
short
long term.
Yes. We will take out the short term from the long term and show it separately. So both amounts are still under liabilities. So it's still liabilities. The one we are just showing the users of the financial statements that this portion is only payable after 12 months and this portion is payable within 12 months, because that tells the users of the financial statements what are the cash constraints that might be there in the next 12 months.
In the next, okay. All right. Thank you.
Yeah. But I just quickly want to check something here. I see here's something I don't think anyone mentioned to me, but the date is not. So the loan from Sarah was obtained. No, it was on the 1st of October. So there's no apportionment that needs to take place there. And this loan was obtained. Okay, also no apportionment. 100%.
Can you explain the insurance thing again, please?
Let's quickly have a look there. Okay, so insurance expense include an amount of 600 relating to the insurance premium for October 2015. So October 2015 falls outside our current financial year because our current financial year ends 30 September 2015. So that means we can't include in the 30 September 2015 statement of profit or loss an expense that relates to the next year. So we need to take it out of this year's expense and then we will include it in next year's expense. Everybody happy with that?
Yes.
Okay, 100%.
Hi, Charles.
Yes.
Last for me, I just want to find out what's the difference of the interest on loan from member of 4,000 rand and the one on the 10,000 rand.
No difference. It's the same interest, but they didn't calculate it correctly. So they gave you an amount and they gave you a way to calculate it under 2.5. So you could have gone and you could have taken the 4,000, but then you would have ignored at 2.5 where they've given you the method on how to calculate it. Meaning you would not have seen that the 4,000 is actually incorrect.
Okay. Actually, all right. Okay, I get it.
100%. So yeah, always try and test.
Okay, I had actually subtracted it, thinking maybe it's already paid 4,000 rand, but I understand.
100%. I hear you. Okay, guys, I'm just quickly going to unshare my screen. I'm going to do a question on the WhatsApp group that I've shared previously. I will do the cash flow question in the next session. I want to do another closed corporation question, if that's okay with everyone. Oh, just show by hands. Who would want to do another closed corporation question? Okay, quite a number. Okay. The question that I'm doing is question 5. I've shared it on the WhatsApp group. I don't think we've done it before. I think it is we'll just double check. It's a statement of financial position. We've done now a statement of profit and loss, and now we can do a statement of financial position. I'm just going to share it on the group again. So if you are on the WhatsApp group, just give me a minute to share it. Okay, guys, I've shared it on the WhatsApp group. Is there anyone that doesn't have it? Okay, I assume everybody's got it. So let's quickly start. So please, guys, let's do this question together. Let's go to the required section. The required section says, prepare the statement of financial position of MCD Traders Closed Corporation as at 29 February 2012. So let's go to our solution. So we know what it is they want and for when they want it. So MCD Traders. As at 29 Feb 2012. So what is the normal layout of your statement of financial position? You have assets, which are divided into non-current assets. Current assets. Leave a few lines open and that will give you total assets. Then you have your equity and liability. Equity and liabilities are divided into equity, liabilities, non-current liabilities. Leave a few lines open, and current liabilities. After a few lines, you can say again total equity liabilities. Okay, everybody happy? So let's start. Non-current liabilities. What is the normal item that we can always find in there? Property, plant, and equipment. We don't know what else there can be. Sometimes they can be financial assets, intangible assets, but you guys haven't dealt with intangible assets yet. So there can be a few non-current assets that rule everything that you intend to hold or not sell within the next 12 months. So if you think of investments, for instance, if you purchase shares and you purchase them for capital appreciation and for long-term investment, that is where it will go to, under non-current assets. If it is held for trading, then it will go under current assets. Under current assets, we have three main items that's mostly there. Inventory, trade and other receivables, cash and cash equivalents. And if we have financial assets, we have we can say we can call them other financial assets, but we don't know whether that's in this question or not. We're dealing with a closed corporation, so the equity will mainly form part of two items. The first being members' contributions and retained earnings, because it's a legal entity. Other items that can be under equity is reserves, such as your asset replacement reserve. Then we have current liabilities. We have long-term loan, and under current liabilities, We can have trade and other payables. And then obviously we can have a bank overdraft, financial liabilities. We can have short-term portion of long-term liabilities, as we've spoken about earlier this evening. And that's basically the items that we can find in your statement of financial position, or the items that you should at least be as a minimum aware of. So let's go to the question. Okay, so we sit here with Tabani and Malebai are the only members of MCD Traders CC. On the 29th of February 2012, the financial year end of the closed corporation, the bookkeeper presented the following information together with additional information to you as the accounting officer of the corporation. So there we have Tabani and Malabai's capital or members' contributions. So let's already go put it in, 220 and 325. So we can follow the same approach. 220 plus 325. We don't know if that's the only movement, but it's on our answer sheet. Retained earnings, opening balance. Retained earnings will most likely be a calculation. We don't know what the calculation number is yet, but it most probably will be a calculation. Then we have the asset replacement reserve, equity. Asset replacement reserve, 1, 2, 3. Don't know if there's anything else. Then we have the loan from a member and loan to a member. The main thing there is the additional information should shed more light on whether it is a current asset or a non-current asset. So we will have to wait, we will have to read the information to determine. Land and buildings at cost, equipment at cost, accumulated depreciation, and then we have investments at cost. So we don't know yet whether that is held for trading or for a long-term investment. Accumulated, okay, we have inventory, 29 February 2012. That is the closing inventory. We have debtors control and creditors control. Bank, a favorable balance. Petty cash, favorable balance. Then we have a mortgage, long-term loan. Allowance for settlement discount granted. Where does that normally go to? It reduces my
sales.
But we are not doing sales at the moment.
Trade and other receivables.
Trade and other, yeah.
It reduces our debtors, so should be under trade and other trade receivables.
100%. So that is where that will go to. We first need to determine whether that it will be that amount or there might be an adjustment. Then we have an interim profit distribution paid to members. The thing there that you need to focus on, it's paid. So there might be a final distribution to members that might not have yet been paid in cash, and that will then result in a current liability. Income received in advance, it's a current liability. Prepaid expenses is a current asset. Allowance for credit losses goes to trade receivables. SARS income tax, debit, that is what we've paid. If the income tax for the year that we receive from SARS, if the income tax amount that we must pay, if we receive that amount from SARS, or we receive what that amount should be, and it is more than that amount, then we must create a current liability. And here they give us the profit for the year that we will use in the calculation of our retained earnings, together with any other adjustments that might still have to be taken into account. Okay, so let's look at the additional information. A debtor owing the business 2,000 is under debt review and it is unclear whether he will be able to settle his account with MCD traders. The members decided to write off his debt as irrecoverable and the transaction must still be recorded. Okay. So let's go to trade and other receivables. And we say calculation 1. So let's do our calculations here. Calculation 1, trade and other trade receivables. What's the trade receivables amount? Let's start with the given amount, 102,765. 102,765. That's the given balance. And we have credit losses. Credit losses of 2,000. Then we have on the number 2, on the 29th of February 2012, a trade debtor who owes MCD traders 4,000 Rand is entitled to a 10% settlement discount provided the debtor settles his account on the 10 March 2012. So that's one of those occasions where we need to determine whether this amount that we've calculated here as, where's that amount? Allowance for settlement discount granted, if that 1,500 is sufficient. Because if it isn't sufficient, we will have to adjust it and work with the adjusted amount. You guys still with me? So let's take that first amount and we say allowance for settlement discount is currently minus 1,500. And let's say adjustment to allowance. So that debtor owes us 4,000 Rand. That 4,000 Rand equals 100%. What should we provide for? Any ideas?
I think we should calculate the 10% discount.
Okay. And that, what is that amount?
Should be 400.
The adjustment should be
400
minus an additional 400. Everybody happy with that?
Yes.
The income tax for the financial year ended 29 February 2012 amounted to 53,800. So calculation, I'm not going to do a calculation for that. Let's see what's the amount, 53,800. We already paid 55,600. So that means we paid more than what we should. So it is current tax receivable. Because we received, or we paid during the year, we paid 55,600. Our actual tax calculated by SARS is 53,800. Everybody happy with that? Okay. The loan to Malabai was granted on the 31st of October 2011. Interest is calculated at 10% per annum and it is capitalized at the end of the financial period. The loan is unsecured and immediately callable. So what does that tell us? It is a
current asset.
Thank you. Kerry, do you have a question?
No.
100%. No, I just saw your hand went up. Okay, so current asset. So I want to do that as a calculation. Calc 2.
I say, you say it's the current asset.
Say again.
Why we say current asset?
Because of that information that's on the screen right there. It's immediately callable. It's immediately payable. So we can expect it must be repaid at year end. So the loan amount loan to member the loan to member 75,000. And also they say the interest is calculated at 10% and is capitalized at the end of the financial period. So we granted this loan to him on the 31st of October 2011, and our year end is at 29 February 2012. So we only had that loan for how many months? Four months. November, December, January, February, 4 months. So interest over 4 months will be 75 times 10% times 4 over 12. Everybody happy? So let's leave that information there and let's go to current assets because we don't know whether that's the final value for other financial assets because they were investments and I haven't read the investment part yet. So other financial assets, I'm just going to say calculation 2. Okay, so we did number 4. Number 5, here's investments. Okay, 40,000 ordinary shares in Mento Limited purchased on the 1st of March 2009 for 60,000. On 29 February 2012, the fair value of the shares held in Mento Limited was determined at 80,000 Rand. So there's 40,000 ordinary shares in Mento Limited. So the moment you see limited, I personally, as I've said before, don't like it if they do that, but in limited, you can always assume that is held for trading, unless otherwise stated, because limited means it's a publicly traded entity. And the shares can be easily sold and disposed of, so that makes it held for trading. Whereas the next one, 15,000 ordinary shares in Royd Pty Limited, is not so freely transferable and cannot be so easily be disposed of. So we can assume that the assumption of the investor was to hold it for capital appreciation, and that would be a long-term investment. And they say on the 29th of February 2012, the members of MCD Traders Close Corporation valued these shares at 33,750. Okay. And then fixed deposit of 48,000 at Stand Bank made on the 31st of December 2007 for 60 months at 12% interest. A fixed deposit is always a current asset because it's something that you can immediately call upon. And then you must just adhere to the fixed deposit waiting rules. Everybody happy? So from this information, I would say that the 40,000 shares in the first bullet point that we purchased from the public company must be included under current assets, as well as the 48,000. But let's just see if there's no further information. Okay, there's no further information. So what do you guys, should the value be?
This is going to be 128,000 the total.
Yes. Everybody happy that the first investment must be showed at 80,000? Yes, no, maybe.
Are we not going to, are we saying the total investment or just for the held for trading?
Yeah, just the held for trading, the first bullet point.
It's going to be at 80,000, you know, the fair value is going to go to profits and loss. So you won't affect the asset evaluation reserve, that one.
Yeah, because it's going to go to profit.
Profit and loss, yeah.
Okay, everybody happy with that? Okay. So let's go to a question, and we say here under other financial assets, we say held for trading investment, 50,000. Fixed deposit. The fixed deposit is 48,000. Are there anything else that we should include there? I think I'm happy. So 205,000. So other financial assets, calculation 2, 205,500. Okay. That's investments, and I think we've dealt with the other items.
Sorry, Charles.
Yes.
What do we do with the interest that we gained on the fixed deposit?
That should go to your retained earnings. It should be included in the profit for the year. So at this stage, they do not state that it wasn't included. Because they just say additional information. So the 48,000, 12% on the 48,000, you will include that if they say it's not included. So then you'll just say it is the 48,000 times 12%. But at this stage, they don't say that it's not included. So I wouldn't include it. But it is something to look out for because you have to pay attention to the wording.
Is that what you were talking about? A similar thing with that first bullet point where there was a gain on the shares, where that would have also gone to be included in the profit for the period.
Yeah, so for instance, this gain, the gain between from the 60,000 to the 80,000, that must be included in the profit, because if you look at the investment here, where's the investment at, because I say investment at cost. So they don't say investment at fair value. So that tells me that if we show it at cost and we don't include it in profit, then my trial balance will balance. But the moment that I include it in my profit, I must adjust my investment at cost as well. I must say investment at fair value.
Okay, I think I'm following you. Thank you.
So that's how I knew that that adjustment must still be taken into account. Whereas with the fixed deposit, it's not really an investment in shares. It is amount in the bank. There's no capital appreciation on it that we must take into account in the various sections. However, the interest question that you did ask is relevant if the question states not yet taken into account. So if there was a sentence here, the interest was not, the interest income for the year has not yet been taken into account, then we would have had to adjust the retained earnings or the profit for the period, which would have adjusted then the retained earnings.
Okay, cool. Thanks.
I just want to mention, so I've seen in a lot of questions where it explicitly says it has not been taken into account. So I think they like give you that wording that tells you you have to still take it into account. So thanks for explaining that. That makes sense.
100%. Yeah, definitely. They will tell you explicitly where, in this case, for instance, they will tell you explicitly whether it has been taken into account. Where we refer to our previous question, where they give you the investment income or the interest income, and then they give you the way to calculate it. And you calculate it, and the calculated interest should be more than what is given in the information, then you use your calculation. So it will always be either one of those two. But whichever the case, it will be explicit in the sense that it will be stated, or you will be able to calculate it. But in this case, definitely, it is. Even if you look at your trial balance, it shows that it hasn't been taken into account because of the fact that it balances. And investment is only shown at cost. So they didn't take it into account, or they did take it into account. Otherwise, it wouldn't have balanced. So definitely, yeah, agreed. Okay, moving on. Income tax we've dealt with. I think we've dealt with most of these items. Let's go now just and have a look. Inventory. Inventory, we already have the closing balance, and nothing in the information stated that the balance was different, so we can just take the 55,000 as is. Then we have to include the trade and other receivables, so let's go to the calculation 1. I don't think there were any other movements, so we can calculate that. Just want to make sure we've included everything here. Were there an allowance for bad debts in here? I can't remember seeing one. Oh, we did. Allowance for credit losses. So don't forget about that one. So in this case, you must pay very quite good attention here. They say the allowance for credit losses is 5,000, but the only bad debt that was written off was 2,000. So we've already provided for 5,000, of which 2,000 has now realized. So the only other amount that we have to take into account here is 3,000. Why? Because provided 5,000, actual was 2,000. So only the difference goes in. Everybody happy with that? There was an actual credit loss of the very first debtor. He didn't pay, but we have provided for 5,000. So the allowance for credit loss that should be deducted is 3,000. This is a principle that you don't see every day, so please mark this question. It's quite an important one. Okay. So 95 and we are on age 52. Let me just put it in there. Cash and cash equivalents. I saw nothing else other than the bank and the petty cash that we read in the beginning. The bank and the petty cash must be together. So it's 37,000 plus the 1050. It's 38,050. Everybody happy? Okay, so those are the current assets. Property, plant and equipment. They said nothing in the additional information. So we can just have a look at the property, plant and equipment. So we have land and buildings at cost, 750. So it's actually everything in that block. So land and buildings, it will be the 750. 247,500, 90, and then minus the 93,480. Everybody happy? And then we must obviously pay attention to the investments right beneath it, because we've now taken out the two current portions, but we must also take note of the non-current asset, which is the 15,000 ordinary shares in PTY Limited, Royd PTY Limited. So it's the 29,000 was the cost, and it's currently trading at 33,750. So financial assets, 33,750. Everybody happy? And I think then we've taken into account all the assets. So my total asset value is 133,985, unless I've missed something. We have our current tax, other financial assets. I don't think we've missed anything. There we go, equipment. We did take that. Investment inventory, did we take in debtors we took into account? We did take bank and petty cash into account, mortgage allowance, all those things we did take into account. Wait. Prepaid expense. Prepaid expense is a current asset. Income received in advance is a current liability. So prepaid expense should still be taken into account. I'm going to take it into account here by my trade and other receivables. Prepaid expenses, it can be showed separately, as I've explained in the previous class as well. But because I'm calling this now, naming this section trade and other receivables, I can include it here. Paid expenditure, 10,200. Everybody happy? Just want to make double sure. Allowance for credit losses, we took into account SARS and profit for the year. Okay, I think we took everything into account in the asset section. So let's look at the members' contributions. Nothing else was said about additional contributions, so we can just take those values as they are given, which is 20. And retained earnings is going to be a calculation on its own. So we can say there calc. I don't think we've used calculation 3 yet. Calculation 3. Okay, let's start with the profit for the year. Given value, the 105,615. And now we need to take into account everything that affects my profit. Okay, so we can look at our calculations first because those items need to go in there as well. So if you look at trade and other receivables, we had the credit loss. Should that affect my retained earnings?
Yes.
Should.
Yes, it does.
It should, eh?
Yeah,
Yes.
less.
Then also the allowance for
Credit
Adjustment.
loss. Yeah.
The adjustment, yeah.
so these allowance for settlement discount,
Grade 3.
eh?
Yeah, zonke.
Them. Because it's your sales, the other two goes to would be expense. 1.500 would be the sales, and then the 2,000 is the expense.
Correct. So the allowance for settlement discount do not go there, but the adjustment does. Everybody happy with that?
All right.
Are you sure though that it hasn't been taken into account though? If I read the question, I'm quite sure that it hasn't been taken into account because they say a debtor owing the business 2,000 is under debt review and it is unclear whether he will be able to settle his account with MCD Traders Close Corporation. The members decided to write off his debt as irrecoverable and the transaction must still be recorded. Everybody happy with that?
Yes.
Okay, so credit loss and adjustment to settlement allowance for settlement discount. So credit loss minus 2,000 and minus 400. Everybody happy? Then if we look at the calculation 2, the other financial assets that must still be taken into account, the first up is the interest. So accrued interest. And it's other financial assets. So it must be added. Staying with the investments. Remember we said the investment is shown at cost. So if I look at held for trading, which must go through profit and loss, it was purchased for 60,000, or the value was 60,000, and it has now moved to 80,000. So that 20,000 jump must be recorded in my retained earnings to the profit for the year. Everybody happy with that? What must we also take into account?
The tax.
And the tax is the 5388.
The tax amount.
Yep. Okay. What else must we take into account? Guys, you've got the question. So I'm going to mute my mic for, say, 2 minutes. And I want you to go through the information and see if you can spot anything else that we might have missed.
Just want to ask, wouldn't the OCI go to the asset replacement reserve for the unlisted shares, the 4,000 difference? Isn't that through OCI?
Correct. What was that adjustment though? It moved from 29,000 to 43,750. That is?
Or the 4,750. Something like that.
Make it neat. I'm going to put this in here.
Where is the 20,000 coming from?
The difference between the 60,000 and the 80,000. Okay, then what we must also take into account, if we look at the given information, remember there was an interim profit distribution to the members of 42,000. Because remember, we're not just working with the profit, we're working with retained earnings. Intra-profit distribution. Okay, everybody happy?
Charles, isn't the income tax not supposed to be the full amount? Isn't it just supposed to be the difference between what we actually paid and the tax expense for the year?
No, it should be the amount that we were filed for. The actual amount, 53,800.
Okay.
100%. Okay. So that's the actual movement. Let's see what value that do they give us here for retained earnings. Retained earnings, opening balance. So opening so our closing balance will be everybody happy with that? Okay. I'm sure we took everything into account here. I can't see anything else that should go to the income statement or anything else that they mentioned. We did the tax. We did the adjustments. I don't think there's anything else that we left out. Okay, 100%. Let's complete that. So retained earnings. Closing balance. Then let's move on to the long-term loan. Long-term loan, firstly, there was the mortgage loan. $232. And then they said here, there's also the loan from member, and the information did not state that there was any current portion. So loan from member. $105. Trade and other payables. Trade and other payables. Trade payables. It's the creditor's value. And that value is 47,240. That's the given amount. Are there any other portion that we should include there? Earlier we read income received in advance. Yes. We can say income received in advance is 5,280. There's nothing else here. Why are we not balancing?
Just wanted to ask you something quickly. What about the OCI? Would that not go to asset replacement reserve, or what's happening? Or did I miss something?
Now remember, asset replacement reserve, we are talking about your property, plant and equipment.
Okay.
Yes.
Would this? Okay.
Yeah.
No, continue. I'll say after you've spoken, just to clarify something.
Okay, so any OCI adjustment will go to let me just open this previous question so I can. You remember we had this other comprehensive income section in the previous question.
Yeah, I remember that section. We would add it there.
Yes.
I know that amount. We would put it there. Increase the total. Okay.
And then that amount goes to retained earnings. So the asset replacement reserve is a reserve on its own dealing with property, plant and equipment. Did I address your question?
Yeah, you did. I'm okay.
100%. Guys, we are out with 2,000. Can anyone tell me why we are out with 2,000?
The credit loss.
It's only 2,000 in the question.
Yeah.
Credit loss. Oh yeah, obviously. Guys, I made a mistake. The credit loss shouldn't be in here for the same reason I explained it to you earlier. Remember the allowance. Where's my explanation that I gave earlier? We already provided for 5,000. That meaning that when we took the value or when we took that allowance to 5,000 initially, it went through profit and loss. It went already through retained earnings. So now we had an actual loss of 2,000. So we can't deduct that from profit and loss because we already provided for 5,000. Everybody happy with that? Only if the actual loss was, say, for instance, 7,000, then we would have provided for it. Because now we balance as well. So the credit loss for the year that actually happened was 2,000. However, we've already provided for 5,000. We already anticipated a possible loss of 5,000, but we only had a loss of 2,000. So to get that balance of allowance for credit losses to 5,000, in previous years we would have had to take that amount through profit and loss to get to 5,000. So we can't deduct the credit loss now again. We've already allowed for 5,000. Only if it exceeds the 5, then it goes to profit and loss. Everybody happy with that?
Okay, it makes sense. Thank you.
100%. Guys, any other questions? Okay, guys, that concludes tonight's session. I'm going to share these questions with you. I'm going to save them now. I'm just going to unshare quickly. I'm going to save these questions and I will distribute them on the group. But if you have any other questions, you are free to ask. I'm just muting my side.
Sorry, I just want to make sure which group this is. I came late for this, so I'm not sure where to find this content.
100%. Let me share this so long. Okay, it's just this side. And I can share this screen. Okay, so it's on the screen at the moment. You can just send me your name. For those that are not part of the WhatsApp group yet, you can send me your name and module code to that number. I'll add you to the group, and then I'll share whatever you haven't received yet as well. Guys, are there any other questions? While I'm on, I'll quickly have a look at the WhatsApp group, and if I've received any requests, I'm sending you the link now.
Can you please explain the credit allowances thing again?
100%. Okay, so how the allowance usually works. Say for instance in year 1, the year the company started, the allowance for credit loss opening balance was 0. Then we had actual credit loss of, say, 1,500, and then we had to adjust that allowance. So we say adjustment of allowance for credit loss. So the company saw, we will have to probably make an allowance, okay? And we said we want to make it 2,000. So we want to top it up from 0 to 2,000. So 2,000. So total credit loss expense year 1 was that value. In year 2, we again had an actual credit loss. Say for instance, I'm not just giving hypothetical examples, okay? It's not in the question somewhere. For me. Okay, let's say for instance this year we had actual credit loss of 2,300, and we saw that allowance is not of 2,000 isn't sufficient anymore. We'll have to top it up with, from 2,000 we want to make it 2,500. Now the allowance top up will only be 500. So my total credit loss expense computer's just a bit slow. Year 2 will be, but what I want you to see here is that every year that we made an adjustment for the allowance, it went through the profit and loss. Can you see that it made my profit less? And now let's say year 3. Year 3, we had an actual credit loss of 4,900. And now the company was like, sure, we will have to make this adjustment 5,000. So now we are going to jump from 2,500 to 5,000. So I want to make another adjustment of 2,500. And that's how we got to that 5,000. Are you with me so far?
Yes.
Okay. Now in year 3, the year that, say, for instance, this question deals with, there was an actual credit loss of 2,000. You agree with me? There was that 2,000 loss.
Yes.
Do we have to provide for anything? No, because our allowance is 5,000.
Oh, okay.
Our allowance is already 5,000. So I'm not going to provide anything. Nor am I going to deduct this because I already have 5,000 in there. There's no need for an adjustment. So total credit loss, okay, let's just fix these years. Year 3, year 4. But the allowance value is 5,000. So I'm covered. And can you see that that 5,000 has been deducted from deducted from profit since year 1. In year 1 we deducted 2,000. In year 2 we deducted 500. In year 3 we deducted 2,500. So I can't deduct the 2,000 now because it's still less than the 5,000 I have been deducting. So I don't have to take the credit loss to profit and loss.
Oh, okay. Thank you.
100%. Okay, guys, I'm sharing the solutions on the group as we speak. And if there's no further questions, you guys must have an awesome evening. And then I'll see you guys tomorrow evening, 17:30.
Thanks, Charles.
Thank you, Charles.
Thanks, guys.
Thank
Have a
you,
nice
Charles. Thank you.
Thank you.
Thank you.
Bye-bye.
Bye.
Thank you.
Thank you. Bye.